Welcome again, everybody. Right, so we'll start with some brief introductions from the panelists with a little bit of background about themselves and how that relates to AI. Let's start with Anusha.
Sure. Thank you, Stuart. My name is Anusha Dandapani. I lead the data science team at Barclays, and I'm also an adjunct at NYU. I teach visual analytics at NYU. My background is I'm a trained engineer, and I'm also a data scientist. So what we do using AI or ML in the bank that I'm part of is we build machine learning models for digital surveillance, trying to understand what can go wrong with regards to conduct risk. And these models are sort of in production, and there's a lot of things that we do with regards to the regulatory and the compliance viewpoint, and then also financial crime mindset.
Thank you, Anusha. Next up will be Ruchi.
Thanks, Stuart. Hi, my name is Ruchi Gupta. I work in HSBC. I've been with the bank for the last 7 years, and I work in the wholesale credit risk team. My day-to-day job pretty much involves making different kind of models, which are pretty much now moving towards the machine learning models, and which also involves forecasting, what will be the PDs, what will be the LGDs, like the loss given default, what will be the probability of default for different kind of scenarios. And then we have been trying to build a lot of machine learning models because of the inherent advantages it gives. And before that, I used to work in a small startup company. And before that, I'm actually a career switcher. I used to work in a telecom domain. But all in all, my career has been basically involved in the analytics.
Thank you, Ruchi. Next up will be Javed.
Yes, hello. Thanks, Stuart. I'm Javed. I'm with Metis. We do training in analytics and machine learning, anything from kind of basic analytics to deep learning, reinforcement learning, machine learning methods, a lot of finance and finance adjacent applications. I've previously worked in a variety of roles. I've spent some time implementing machine learning models at scale at Amazon, automating forecasting processes and analyzing customer behavior. I also spent a number of years at the Federal Reserve as an economist in bank regulation, so overseeing the econometric practices of large banks in terms of risk management, model building, etc. So my training is in financial economics and statistics, and before grad school, I spent some time working in the finance sector in private equity investment banking type of roles.
Thank you, Javed. And then last but not least is myself. My name is Stuart Neilson. I work at Citi. I have been working at Citi building credit risk models since 2008. I have not been using artificial intelligence for those models since 2008, but we are now moving in that direction, and still in many ways it's pretty early in that process, but it's a very exciting process, and we'll talk some more about that as we go through the panel. So I think that will lead us into the first question. Thank you. All right, so here's the question let's start with risk. Broadly, how does AI help a bank manage risk? Secondly, how do you manage the risk of using models? How about for this one, we start with Ruchi.
Okay, I'm the lucky one. So how does AI help a bank manage a risk? I think firstly, before that, one of the biggest advantage I see of AI providing is like there you have so much unstructured data, and then you have so much structured data. So all the technologies which you have, they definitely help you, like the basic regression techniques and everything. Definitely they help you in passing out all the structured data and everything, assuming a data size is small. But as your data size increases a lot, the one thing you have to look at is AI. That's one of the benefits AI can give you. And then secondly will be the unstructured data, in which AI gives you a tremendous advantage. So definitely in the field, looking at structured and the unstructured data, that's how AI helps you in managing your risk. And it's not just managing. First of all, you also have to figure it out where a risk is. You have to understand that. So that's the benefit which AI provides. In terms of how in my current role it helps us, and how does the bank manages the model risk? I mean, we at least in HSBC, we have a whole framework of it, which like there's a whole governance process involved, Then you have which takes care of, we make sure that we follow the proper process. That's definitely in one way help us in managing the risk.
Does anyone else want to chime in on that one? All right, I'll say what I what people I, yeah, go
I'll
ahead,
go for
Anusha.
it. I'll go for it, sir. Thank you. So the AI risk, from my perspective, right, like the business use case and the regulatory interest has sort of gone up exponentially in the recent times, right? Like, and there is a tremendous potential that exists on how we can make key decisions using AI or ML based approaches, especially when it comes to sort of like, you know, products that we are already using in our decision-making process. And however, the key risks that that we do foresee for AI that may affect organizations or consumers, because, or they can also create broader detrimental effects on society. Such risks typically are arise in the whole or in part in sources that we use, especially the data that we use to train these AI systems. And these risks also are not just from the AI systems itself. It's like how we use these AI systems and like what sort of decisions that we drive based on these systems, and also risk arising based on the poor governance of these systems. You know, those are the sort of risks that we use AI to help manage. And then also, there is also a big gap that currently exists in AI governance. This gap kind of like, you know, needs to be addressed from our perspective. Is that like, you know, how are we classifying these risks? What's the taxonomy around it? What are the mitigation techniques that we can actually use AI and ML to resolve these risks, especially in the financial industry? And that is something would be very interesting to watch out for.
Thank you. Javed, any further comments?
Yeah, I guess I would say that, you know, in the way that you know, you can calculate your exposure using a calculator. You know, AI is a tool that can help you to calculate things when you're managing risk, and I think it's been around. There have been some developments, but fundamentally, risk management is a personal and human-oriented process where you can use tools, and the tools can help you, but it's kind of very dangerous to rely on those tools as a crutch. So, as a point of reference, in terms of kind of banks and stress tests, you know, the Federal Reserve in its severely adverse scenario, which was published in February of this year, forecast that, you know, unemployment would go up to about a peak of 10% by the third quarter of 2021. And so, you know, if that was your worst case scenario, you know, we were way off in terms of what actually happened and what we might have been planning for. And so this is not something that I think could be picked up by even the best of models. So I think in the context of maybe determining, you know, how much capital to allocate for a particular loan relative to another loan, using the best models can help us. In terms of holistic risk management, you know, I really think it's important that I don't think that the game has changed there in terms of the human element and the importance of managerial input in risk management over the last, you know, 10, 15 years.
Right, thank you, Javed. And right, that is an excellent segue into our next question. Speaking of the human element, let's talk about talent. When it comes to AI, either on the business side or the technical side, which type of people have become central to your AI projects? Is upskilling part of those people's journey? Let's start with Anusha for this one.
Sure. The AI models are similar to software, and they are prone to the same sort of roles that you would like for people who are central to AI projects also to play. But there is a growing awareness of, you know, what sort of people, talent that we need to have in place when we are focused on building AI-based technologies, right? Like both, you need people who understand the sort of the legacy aspect of technology, and also people who understand the emerging aspect of technology to be part of the team that you are focused on with AI projects, and then also sort of the personnel who are actually prepared to understand not just the data science aspect of it. You need also folks with subject matter expertise of, like, you know, if you're dealing with security, cybersecurity, if you're dealing with legal, and also personnel who are very aware of bank's liability with compliance and regulations and the sort of the credit risk aspect of it. So the people who you need to be sort of working with when it comes to AI-driven projects is a mix of both. You need the data scientists, you need your engineers, and you also need the domain experts, or what we call as the subject matter experts, based on the use case that you're working with. And fortunately, in financial services, they were able to sort of adapt seamlessly when it comes to migrating from traditional software development to sort of AI-based or machine learning-based sort of technologies. It's just that bringing the people together is the key to solving problems.
Thank you, Anusha. Any other comments on the talent part of the equation?
I can probably just chime in and just add up on what Anusha mentioned. I think one of the important thing is, it's like you definitely need people who understand the machine learning techniques, but it's also important to explain it in a layman term sometimes, because that is one thing. It gives the confidence to the senior management that you really know the models, because sometimes your model give you a variable. In terms of the performance, it might be an amazing, it's capturing all the key risk and everything. But the other thing is that comes into effect is that it really makes sense to put that variable into the model itself. So having actually able to understand what your model is, able to explain it, and having a good understanding of it, that really helps.
Thank you. Any comments, Javed?
Yeah, I can chime in, since upskilling is one of the areas that we focus in the most. I think one of the dangers is to have this kind of black box component in the quant side for any firm. And I was reading a recent study by McKinsey, which suggests that across industries, including banking, but across all industries, the more management is involved in analytics, and particularly at more and more senior levels, the more likely firms are to do better relative to their competitors and things like profitability and sales growth. So I think that in terms of talent, what talent is important, and what, how does it relate to AI? I think it's increasingly important that kind of everybody at the bank have a certain baseline level of literacy with respect to some of the tools and techniques in machine learning and AI. And the more that's the case, the less there's going to be a black box in the quant side of things. And I think that the more that people can bring management into all facets of quantitative development, the better.
Thank you, Javed. Okay, I think we can go to the next question now. I've seen some related stuff in the chat that would potentially relate to this question. So the question is, which AI use cases have you found to be the most compelling? And this time, can we start with Javed?
Yeah, so there's certainly a lot of compelling use cases, from underwriting, risk management, compliance. The scope for analytics is pretty broad. I think one of the things that's really newer is this focus on using best practices to ensure that things like biased inputs and biased data don't make their way into lending decisions. And so there's certainly always been a frontier of better risk modeling, better exposure, and the fintechs are attacking that frontier pretty aggressively right now and kind of adding additional layers of disintermediation. But I think within the bank, and one thing that's really changing is we can systematically use our machine learning models to ensure that you know, that we're not incorporating biases into our decision making, and that's an area that you know, I think is growing very, very fast. You know, people are not doing it as systematically as they really could be.
Right. It's certainly it's always been true that human-based decision-making processes and machine-based decision-making processes, you have to worry about the bias, and there are ways that you can deal with the bias, and certainly a lot of the financial industry context, you absolutely have to worry about the bias, but then an intelligently designed artificial intelligence will you know, be able to do that. Any other comments, Ruchi and Anusha?
I can say something. So basically, I think one of the use cases which I've seen in AI is in terms of streamlining in the risk management, especially development of the challenger models. Because I mean, anytime you develop a champion model, which is actually used for all your processes, you always develop a challenger model to see what you could have done better. So the AI definitely allows you can use different kind of techniques to see what I could have done to make my probably model better. This also gives you sometimes a lot of insights about your data or different technologies or something like this you can use. So definitely this is one of the use cases which I've seen a lot.
From my perspective, to add on to that, is that AI use cases are very effective when it comes to credit card fraud detection, identifying anomalies in credit card-based transactions. Second, very sort of prevalently used is surveillance and outlier monitoring sort of use cases of AI. That is what we are focused on right now, to identify anomaly and bad behavior and things that it is humanly impossible for us to do. So all these sort of use cases are augmenting our human decision-making process. We are not getting rid of the human involved in this process. We are just helping our humans who are deciding on certain sort of decisions, make better decisions. It's basically enabling them making smarter and intelligent decisions. Certain other use cases that I'm very, very sort of interested in and also optimistic about are something like, you know, cybersecurity and preventing adversary attacks that can come about to an institution, and also doing anti-money laundering network analysis. We're trying to understand what is the sort of the transactions that are exposed to underground networks that you don't want to be part of. And then also very interesting upcoming use case is this customer segmentation and driving insights about your customer, or 360-degree or holistic view of your customer even before you end up working with your customer. These are sort of important, and then also sort of use cases where there is human involved, and they also become trustworthy, like as Ruchi and Javed just mentioned. Explainability is a very, very important component in the sort of the regulatory space that we are exposed to. But however, improving the explainability is based on the testing and the trust that we build around these decision-making models. How do we do that is improving the transparency and testing them effectively, and also identifying potential human bias that can get introduced in the kinds of algorithms or the choice of the models that you choose to solve that problem. And then also inadequate monitoring. Like what I mean by that is, if you don't monitor these models, there is this component of model drift that can get introduced over a period of time. So model monitoring will improve the trust around these AI-based models.
Right. Certainly, we've got some sexy areas of application being mentioned here. Certainly, the detecting crime with artificial intelligence is an exciting area to be in. And so you've got the fraudulent transactions, you've got the money laundering transactions, and banks are now using artificial intelligence to detect such things. Another kind of area of current development, which could be very interesting, is kind of in the consumer credit realm, using alternative sources of data to develop models for consumer credit predictions. And one other comment that I'll make is that the exciting environment where we're in now, where we've got all these techniques are available, the technology is there. Meanwhile, we've been spending all of these many decades using kind of more traditional kind of statistical models, running regressions and such, and those models didn't suddenly stop working. They are not going to disappear. They're going to be operating alongside artificial intelligence for some of the applications, but bringing in the artificial intelligence, it adds a whole lot more flexibility to what you can do in the modeling, and it enables you to use types of data that you otherwise wouldn't be using in traditional statistical models, working with text data. And there's so much data out there, and the potential applications are only just beginning to kind of penetrate into the financial industry. Other industries are somewhat ahead of finance, and other industries are behind finance. And there is so much that is going to happen going forward. I guess that might be a good time for the next question. Thank you. How has AI become integral to compliance processes? How do you ensure explainability to regulators? And let's start with Ruchi for this one.
Okay, I think the explainability has always been an issue with AI. So, I mean, it's considered a black box. So getting everybody chiming in and giving that kind of a comfort that we know it, that's still a work in process. We are still working on it. But as I mentioned, definitely that's what it goes back to the second question which you asked in terms of hiring the people. So the people need to actually, it's just not just running the model and just pulling something from the Python, using all those things, coming up with some kind of a model. It's also important to make sure that you're able to explain to the people what you have done, that whole understandability of your whole model. I think that's one thing which is going to give the confidence to everybody out there that it's not just a black box, and you really actually understand what goes in, what is inside there, and what comes out of it.
Anyone else with comments on that?
Sure. To add on to that, right, like, the space I'm working on, especially within compliance regulatory norm, is very, very sort of stringent. So where we work about sort of not solving for this problem, but mitigating this problem, is focused on working on supervised approaches. So that way that you can take 20 steps backwards to explain why you got to that sort of a decision. Why did the model arrive at that sort of a conclusion? And then also this concept of explainability is something that we need to sort of step back and understand. There is a real difference between explainability and interpretability. Explainability is a sort of very much defined by, it's always sort of defined by how much of your trust is built around the models and the decisions that we made by these models, and how effectively can you sort of test and trust them. And when it comes to interpretability, it is the sort of the kind of tools that you use to interpret what the model decision ends up being, or the predictions ends up being. So similarly, explanatory tools are available in plenty. There is something called as, frontline fairness tools. We can make sure that we are sort of like, abiding by federal laws and the laws that are protected against the individual, to make sure that we have those sort of compliance standards in place. But the other sort of thing is that explainability and interpretability can be misused, because it is about the comprehensibility of explanations is what we need to focus on when it comes to AI and ML-based sort of approaches, because it is very, very important to comprehend versus just to explain, because what you explain can be misinterpreted also. And or how the touch points about how you are using these models, like, how do you interface with these models? What sort of interactions do you have with these models? What is the level of human interactions that you have with these models? These are the things that you need to sort of highlight, make it transparent. The lack of transparency kind of puts that explainability in a question, and then also the decision making or the subject of decision making in question. So I'm all in favor of transparency, and then also about testing and trusting the system.
Thank you. Javed, any comments on explainability?
Yeah, I can say as a former regulator who has had a lot of people explaining models to me, various types of implementations, that I find that tends to be the case when people themselves really understand what they're doing on the modeling side, they're better able to explain it. And it's usually the case that the people that come from the regulatory side, whether it's the OCC or the Federal Reserve, they're going to send people that are versed in these models, that understand the ins and outs, that understand the technical part. And so the technical part is usually not the challenge. But the explainability is one thing that I found often as a regulator that could kind of use improvement, in the sense that people have a tendency to dive into the really technical details and maybe not do as much as they could on validation. So I like Ruchi's statement about always having a challenger model, and I think this concept of always having a secondary model for validation is increasingly important. As we move from, let's say, regression-based models where you can do interpretation of coefficients and the like, and we move into kind of more advanced ML and deep learning and models with more moving pieces, it becomes harder and harder to say, okay, this factor is doing X and this factor is doing Y. So we need some kind of systematic external approach that's model agnostic to do that. And the more we can do that, and there are ways to do that so you can have a challenger model, a validation model. That's one approach. Another approach is to, let's say, systematically vary inputs in a way that's consistent across models, and then measure the corresponding change in outputs. Having that model validation function, I think it becomes increasingly important as we have more and more levers and more parameters associated with our models.
So I've certainly, in my career, I've been in the position of trying to explain models to regulators, and also had a kind of a general discussion with someone from a regulatory agency about, explaining, newer artificial intelligence type models. And the regulator pointed out that, if you're going to be using these models, you don't just have to explain them to the regulators, you also have to explain them to your own management. So the regulators who you're working with, they're going to be some variety of quant, whereas the people in the management that you work with, they're not always of that type of background. So, and it's like the kind of explainability threshold when you're trying to explain it to regulators is like, you're probably going to do okay explaining to the regulators if you understand them well enough yourself. Which with some of these models, that is a significant hurdle. But you also have to explain them to there are other stakeholders involved who also are going to have to explain your models too. So I think
I can just add to that. It's something like I tell it to my daughter when she's trying to read a book. I said, if you really know you understood the book, is if you're able to explain it to me in like 3 or 4 lines, what I've actually read. So it's something like that. If you actually know your model, if you actually understand what's the whole technique behind this model, and if you can explain it to somebody without using all the technical jargons, that is what the explainability is.
All right, now, so I guess we're going to the Q&A session at this point.
I agree.
There's a bunch of questions.
You all crushed it. And now I'm going to step in to help with the audience Q&A, of which we have a lot of. So hopefully we can get to most people's. All right. So COVID is obviously a key word among some of these questions. So one interesting one, given the current COVID situation, which is an aberration to the historical data, how are AI models going to factor for the shift in this aberration and predicting outcomes? So how are you dealing with updating models for this COVID aberration?
Who wants to go first? So from a data perspective, COVID it's right, obviously it's going to end up representing some new data. And when you're in the kind of risk realm in a bank, you need to have data that represents the crisis situation, the scenarios, to use the parlance, that represent the worst possible cases. And COVID is going to be at least some way down that direction. So from a modeling perspective, COVID, right, whatever ends up happening is going to get used by the banks as useful information for the types of modeling that they need to do.
Let me add there that this is a very dangerous type of approach, I believe, and we saw this with the crisis in 2008, that basically you have a downturn and it's so you know that it's somewhere in the tail, but you don't know how far in the tail it is. And you'll have a regime that comes out of this where you will no longer be in kind of a downturn situation. And so the challenge is, when you're not in a downturn situation, how do you incorporate the risk of a downturn? And when you do that, you have to make some assumption about how far in the tail the downturn is, and then how much you emphasize it in your model. And because of those two parameters are so broad, I guess one of the risks there is that you can basically, by tweaking those parameters, achieve any outcome you want. So I think it's important to remember that most of our models, when you look at statistical models, they focus on stationarity, and anything that crosses the COVID situation is not going to be a stationary situation. So your typical statistical assumptions are not going to apply. So what that means is incorporating COVID, incorporating these unusual events, is entirely a matter of judgment. It's not something that AI is going to do for you. It's something that you're going to have to use your own judgment to do, and it's something where there's no kind of clear-cut answers. But I think it's important to remember how much freedom people have when incorporating these items into their predictions.
To add on to Javed's point is that, yes, we are also in the sort of wait and watch mode right now to see how the data pans out and like how the sort of the post-COVID world will look like. And definitely we are gearing up to see how we need to retrain our models. What are the factors that we need to reconsider, especially when it comes to sort of the volume of the transactions that are totally different in the post-COVID era. So at the moment, we are in a wait and watch mode, and definitely there will be a sort of impact and sort of remediation that we need to sort of focus on. Probably by end of this year, we will have that sort of clarity. We are not there yet.
Yeah, just to add on to everybody's point, I think we'll see definitely some qualitative impact and quantitative. So it will not be just by, as Javed mentioned, like most of the variables, you look at the stationarity and everything. And the situation like we are seeing, like unemployment rate suddenly jumping from 4 to 14%, it will be hard for any pure statistical model to capture it. So we'll be seeing some kind of a qualitative effect added to the final models, which will eventually come in after everything goes back to normal.
Cool. Thank you all. All right, let's see if we can get a couple more questions in. So this one is about ROI. The person asks, what type of AI tools are used most in the banking system, and how can we calculate ROI? And to add a bit more of a frame to that, so the past 5 years, really in earnest, banks and every industry, but this is about banks, have been spending a ton of money, energy, time on building AI teams, working with outside vendors, experimenting with AI products. How are your banks thinking about the ROI of all this energy? Is there some overarching plan that you're able to say this is the ROI of our AI effort over the past X number of years, or is it a little more random than that?
So I guess I'll step in first. Right. So you've got some of the applications which are, proven at this point in the realm of AI, and you've got some that are exploratory, and various kinds of areas in between. Right. And then there's enough that has been proven in general Some banks more than others, obviously, but overall for the banks and banking industry in general, there's a fair few kind of proven applications that have shown that they help the bottom line, they help the bank's business, and they are worth the investment in them. And right, and there's likely enough momentum there that will carry to the next things that naturally fit in, that will move from speculative to actually applied.
Yeah, I would just say I think this is a really tricky one because you're going to build a model to measure ROI, and the model is going to have a lot of inputs and degrees of freedom as well. There are some things where you kind of have to just invest in business transformation. And we see a lot of the biggest firms like JP Morgan really doing that. Going all out. And do we know that every single initiative is going to make its way on ROI? Anti-fraud and those kind of things might be easier to calculate. But I think as we see the emergence of fintechs and coming up to approximately 10% of residential mortgage lending, at some point the ROI becomes kind of staying alive and remaining competitive in in what's a large and growing market. And so I think in many of the cases, the ROI calculation is a little fuzzy, but nonetheless clear cut because a matter of survival and kind of remaining competitive.
Any other thoughts on the ROI piece?
Well, yes, it's a good point that Javed made, that it is a matter of survival. There are other market players that are there alongside of the banking industry. They're going to be innovating in their offerings, and the banks have to, in order to stay relevant.
Nice. All right, ROI. So I guess the answer is, well, time will tell. All right, so there's a couple more here we should get to. So one kind of very broad question, but interesting for people in the midst of this, like you all. What percentage of banks globally, have shifted to AI-based models? So I guess does every bank now in the U.S. and world have models in production, or is it still the 20 biggest banks just in the U.S. that actually have models in production?
So like rather than whether saying a bank is in or not in AI, it's like what percentage of the bank, within the bank, different parts of the bank are going to be in AI for different purposes and not for other purposes. For the industry as a whole, if you take that within bank percentage, it's still not that high of a percentage. But every bank every large bank has at least been stepping in with some of its areas of operations.
Yeah, I agree with what Stuart said. I think it's just hard to say what I looking at individual banks, because as far as I think, every bank is doing some kind of a work in AI, but it again depends upon the kind of portfolio you're trying to target, depends upon the kind of risk you are targeting. Some are probably easy to capture or easy to handle better with AI, and some probably require more conventional, traditional hands-on model. So it totally depends upon the kind of the risk, the kind of portfolio you're targeting.
And from my perspective, to add on to what Ruchi just mentioned, is that yes, most of the AI-based solutioning that's happening across various banks is depending on the business problem or the use case that they're trying to solve. Not all use cases are sort of effective, as I mentioned, like, something like fraud detection or these sort of use cases already have this sort of inbuilt reason to adapt to AI, because that's going to definitely effectively solve the problem. But when it comes to something like where there is this new way of doing things, where like the banks are trying to figure out if they can end up having virtual relationship managers to help making decisions for their customers when it comes to sort of managing their assets, and wealth advisory, where they're trying to figure out if there is a better way for us to advise our clients 24/7 without the limitation of human involved. those sort of use cases are interesting, but however, how far along other banks have made progress, we don't know. But within the regulatory sort of interest sort of space, business use cases are very well defined. So yes, most of the banks are adopting to AI-based sort of solutioning. Tier 1 and Tier 2 banks, yes.
Awesome, thanks. That was good intel. And then we have to switch to the next panel, but I'm gonna do one more question, which I always find interesting. So Carol asks us, what's the criteria to decide whether to build an AI solution internally or use a third-party AI product? What's your approach to that decision? Or do you have no approach?
It is a bit of both. It's about trying to understand how far along are you in the cycle of evolution of adapting to AI-based solution. In our case, we do both. Sort of like, it is about the decision of whether it's time to market, whether do you want to bring the solution on board, or do you have the luxury of time to build a solution of your own. But the sustainable approach is to build on your own and then also buy where you see that there is a necessity to fill the gap.
Got it. Thank you. Yeah, that's good to know. Any other thoughts on the build v buy concept?
I can mention something. I think it's the use of the third-party approaches is kind of a double-edged sword. It's definitely something that shows some prudence if you're finding external provider that can help you to calculate some important quantities, implement some best practices, but there's the other side of it as well, which is is the bank kind of shifting responsibility to that third-party provider for something where okay, now if there's a mistake made, where's the onus of responsibility? So I think it's important that whenever the third parties are used, that what's going on is understood enough, and the bank is able to also kind of take responsibility for whatever gets implemented, regardless of the source.
It goes right back to that explainability that we were discussing earlier.
Yeah, so this kind of introduces this additional risk factor that wasn't there before in our risk calculations, is this third-party risk management, trying to understand what sort of TPRM sort of transparency and model interpretability that comes along when you end up buying a solution or a service provider-based sort of solution. And one of the main reasons that we always sort of watch out for is understanding the contractual clauses in these third-party sort of solutions to understand who owns the AI system testing and who owns the explainability aspect of it and who is the real owner of the intellectual property that you create, because end of the day, the person who owns the data owns the intellectual property.
Got it. All right, so if you're gonna buy, there's gonna be some extra considerations, which makes sense to me. All right, everybody, thank you so much for your time and perspective. This has been awesome.